Okay, in this video, we're going to do real options. Options not as puts and calls, but options for businesses. There's three different kind of options I want you to think what a business could do. They have a new product. They could delay it for a year and see what's going to happen with the market, or if another business might jump in, or there might be FDA approval for other businesses. Another one is a growth option. That means, the project doesn't seem like it's a great value, but there might be a opportunity that's kind of connected to the project, but there could be a growth opportunity. And the other one is if there's an abandonment option. Abandonment option means that could we put into it, if things go south, can we shut things down, and would that make it more worth it? So pull up the Excel sheet, and what I'm going to do here, we're going to do, I'm going to do this first option. I'm going to do a delay option where I'm going to type it up. And then the next one, you could do it yourself. So if you notice, like, this one is blank, it doesn't have a lot of the gray cells. And then this one you have to do. I have it all nicely typed up. So we'll kind of work with that. We'll do that on that. And then same thing with the abandonment option. We'll type it up. You're supposed to follow along as well. But and then you can do the rest here. All right. So the first one is, I got to change that. I changed the first name of Blazik Court, but then I didn't change the rest of it. But it's supposed to be a company is considering to plan to develop an online finance tutoring package that has a cost and revenue projections shown below. One of its competitors, which is called Online Professor, is expected to do one of two things. One, develop its own competing program, which will put Tutor's program out of business. So we're worried about if they create their own program, there's no way we can compete. Two, offer to buy our program. That would be, if it decides to do this, would be less expensive for that for that company than developing its own program. Tutor thinks that there's a 35% probability this would happen, and if they buy it, it'd be worth $5.6 million. So first we'll do the cash flows, and then we'll see there's a growth opportunity. There's a 35% chance that we'll be bought out, and that's the goal of should we go forward with this. So I already have everything typed up. The cash flows, it's going to cost us $2.8 million, a whack of 9%, and we have our cash flows for 5 years. Now remember, the purchase was $5.6 million. That was in year 5 as well. So all we're going to do here is we're going to think about the cash flow. So first off, I wanted you to do is we want to do the net present value of just the cash flows by itself, not including that possibility of purchasing it, being bought out in the 5th year. So we'll see if it's worth it. So we'll go equals. I'm going to do that. Plus, I'm going to go quick because we've done this a million times in this course. So as you see, the cash flows by themselves gives us a negative $466, which says it's not worth it. It's not worth doing it because we'll lose money. We would not take the project. But there's that possibility we will get bought out. That's a growth opportunity. So what we're going to do is we're going to do the future value of the purchase. So what I want to do is we think there's a 35% chance the purchase would happen. There's a 65% chance it won't happen. So what you're doing here is the expectations, the average of that value. So I'm going to take that probability and multiply it times that value. And then I'm going to say plus the probability, 65% times there's a $0 value. So we could say, well, because it's not going to happen for sure, we're saying that the future value of that purchase is really worth $1,960, or that's 1.96 million, because there's not a 100% chance that will happen. Now what I want to do is I want to find, well, that's 5 years from now. When we examine things, we have to find the present value of that. So I'm going to take that and I'm going to divide it by 1 plus, the whack. I'm going to do it to the power of, well, it happens in the 5th year. There's a bunch of ways you could do this. You could have just added that 5.6 right here to that 600 million. Or not 600 million, what are we in? It'd be 600,000. You could just add it there and then do it that way. But I wanted to show you this method as well. So imagine that you have those cash flows, and in the 5th year, you would have taken, not the 5.6 thousand, I said it, you would have put the 1,960 added on to that 600, and then if you do the net present value, that would be the answer. But I'm going to show you this step by step. Now we got the present value of that. That's the present value of all these cash flows. So now all we have to do is add them up. Present value plus the present value of that purchase possibility. So this gives us a net value, which means we would take the project because it's greater than 0. All right, so we're going to type this up, and it's going to look like this. So let me just read it kind of fairly quickly. Norris Production, so MPC is considering a project that has an upfront cost of $2,250. The project's subsequent cash flows are critically dependent on whether the competitor's product is approved by the Food and Drug Administration. If the Food and Drug Administration rejects competitive product, MPC's product will have a high sales and cash flows. But if the competitive product is approved, that will negatively impact MPC. So in other words, if the FDA approves our competitor, it's going to negatively impact us. If it rejects it, we're in the clear. There's a 60% chance that the competitive product will be rejected, in which the case MPC's cash flows is 733. A 40% chance we'll only have a 50 because it'll be accepted and it'll affect our cash flows. Now, MPC is considering whether to make an investment today or wait a year to find out about the FDA's decision. So instead of going with the project, what we can do is, why not wait a year and then see if our competitor gets accepted or rejected? And if it gets rejected, we'll just go with our project. We want to see which one's worth it, starting today or waiting a year. So here's the downside. We got time 1 through 7 of cash flows. If we wait a year, it's not like we get 2 through 8 cash flows. Then we get 2 through 7. We only have 6 years of cash flows. If you wait, because this is time sensitive, we know that we only can get it up to a certain year. If we wait, we're going to lose that as well. So that's something to keep in mind. So what we're going to do, I got to follow how I did it exactly. So what you want to do is we'll type in years, and then we'll do the good scenario, the bad scenario. Excuse me. I got to make sure probability. I had an idea to do it this way. And we'll see if it works. So we said it's a 60, right? 60 to 40%. There's a 40% chance competitor's product will be approved. So this would be 60 and a 40. That's how you want to type it up. And then I believe I had the WACC. It showed up there right here. And the WACC on this is 17%. Maybe I had it up there. Oh, that's why. I'm all over. There we go. There's a 17. I knew it was somewhere around there. It's like a shot in the dark. I thought this would be a good way to lecture, but the only downside, I kind of forget where I put things at, right? So what do we got here? We got probability, and then we got years. So we're going to start our years by going 0, 1, and so on. So if you highlight a trend, and I drag that bottom box, it will know it's a trend. We go out to 7 years. And then we want to put our upfront cost, which is a negative 2250. If I copy that or drag it down, it'll do the same value. And then 733 and 50 if it got approved or cash flows. So I'm going to go all the way out. And then what we want to do is I want to find out, let's find out the net present value of each scenario. Then I'm going to find out the net present value times the probability of it happening. And then we can see what our our expected net present value is if we start immediately. So let's do that first. I'm going to do equals, and I want to do, and always remember that, times 0 is outside of it, and then we'll do net present value, rate, and then I'm going to go over. Now you can't see it. Make sure you're at that last column right there. It's kind of hard to see. So we have a positive if it goes good, if they get rejected. Little tip here, I want to drag it down. So all I want to do is put function at $4 in front of that rate, which means I can just drag that down. So if things go good, we have it's 625. Things go bad, it's negative 2000, so we wouldn't take it in that scenario if it goes bad. So now but there's a probability, like if it was a 90-10 or a 99-1%, that changes everything. So what we want to do is do the net present value, and we're going to multiply it times the probability of that happening. That's our true value of our cash flows. So now what we're going to do is get the immediate net present value. So we're just going to sum those up, or this is the expected of all the good and the bad. So you see, it's a negative 446. We would not take the project. Now here, I'm going to give you a little tip about delay options. If you had a good and a bad scenario and the bad had a positive net present value, the delay option statistically cannot be worth it. It's only worth it, or there's a possibility a delay option might be worth it if and only if there's a negative on the bad side. That's something to keep in mind. All right, so I'm just going to copy that. Now we're going to do the delay. Excuse me, can't get rid of this cough. And so nothing really changes here. It's a 60-40, the good and the bad. And then we're going to do our years. Oh, I didn't mean to do that. We'll do our years up here. I'm going to drag that. And remember, it only goes to 7 years. So we don't get that extra year cash flow is cut off. So we want to say this. If we delay, you want to think about it. At time 0, what's going on? We're not doing anything, right? It's just blank, $0. So there's some downside. I'm going to give you 2 downsides of a delay. First off, if there's another competitor or you're trying to bring something to the market and you're going to delay it, ChatGPT is the #1 AI is because they're the first to the market. You're risking not being first. That can be very dangerous in that regard. The other downside, that's a whole year of cash flows you're not receiving. So I'm just going to make sure I did do the same for both of those. All right, so what we're going to do here is, so nothing happens at time 0. At time 1, that's when that project would start. Right? And then at time 2, that's our delay. This is when we get our positive cash flows. And you can see we're limited on the positive ones. We got 6 years rather than we would have had a lot more. So we got to do the same thing. We'll do the net present value, and then we'll do the net present value times probability to find out what it is. All right, so we'll do that. We're going to say net present value. I know it starts at time 1, and what we want is the net present value at time 0, right? But we're going to treat this as next year. So say this is next year, and we're going to say at time 1, what is it worth? That's what we're going to treat it as. So next year, this would be time 0, if that makes sense. So I'm going to say plus, and then we'll do the net present value. I'm going to do the rate, comma. Again, I forgot to do it right away. If I put a dollar sign in front of that rate. That will give me the ability just to drag it down. It'll do the cash flows down there. Now I want you to think about what it means to delay it. You see how that's negative? If I delay it, I get to see if they get rejected. So now let's do the probability thing. So we say, okay, if we have a positive value, if they got rejected, there's a 60% chance they'll get rejected. That's what it's worth, right? However, if they get accepted, I want you to think about it. They get accepted, I get to see what happens. What is the probability of you taking that on, right? It's not a 40%. If I'm going to lose money, it's a 0% chance I will take on the project. Because I delay it, I get to see what happens. All right, so now what we're going to do is we're going to add in our expected net present value. Now, if you notice when I do this, it is incorrect. Now, why is it incorrect? It's because this is delayed a year. I treated it as next year. So that's time one, which means this is a year from now. Now we have, that's what it's worth next year. I have to discount it today. It's the present value. So we're going to take that value and divide it by 1 plus the WACC. And that's 1 year. So you do it to the power 1, same thing. So that's the value. Okay, a couple things. What is the value of the option? Now, this is important. The value of the option is normally, like this is how you would do it, the difference between the value of the option, which is 195, and if you didn't do the option, okay? Now, if I do this, it's going to be incorrect. Because I want you to think about why. That's what you typically do. So if this was worth $100, you would take this minus that. Since this is negative, we would not take it on. So if you have a project that's negative, it's really worth 0 to you. That's important. So the option is worth 195. All right, one more, and then I want you have to fill this out. These are just different numbers. It's good practice to get good at it. All right, I just want to make sure I'm doing all the cash flows correct. No tax, new tax, probability. No, okay, I forgot. I'm going to have to go back and forth, make sure I type it up right. So it's 3 down. Let me just type that up real quick. So no tax and tax. All right. So let's read the problem. The company is evaluating a project in India that would require 4.8 million investment today. The after-tax cash flows would depend on whether India imposes a new property tax. There's a 50-50 chance that it will pass, in which case the project will produce after-tax cash flows of 1.33 million. If it doesn't pass, it's 1.9 million. It's going to go for 5 years, a WACC of 11.8%. So I'm just going to make sure I do this right. Got that. Do I have a gap? I do have a gap. Don't ask me why I did that, but all right, probability. So we got a gap. This is the probability. Oh. I can't drag cells or it messes up my green cell. All right, probability of that happening. What do we say with the tax passes 50-50 shot. So that's simple. So 50-50 chance. And how did I do that with the cash flows? And then I typed up the cash flows right here. So we'll call that the cash flows. Cash flows there. And then we can start our years. We can go 1 or 0, 1. Let's do those. And then that would go up to 5 years. All right, we have an upfront cost of 4.8 million. If things go with the no new tax, that's a good scenario. That's 1.9 million we would get. And if it does pass, it's 1.33. Oh. All right. All right, so we got the cash flows in there. Now I want to read a little bit. This is called the abandonment option. The firm would have the option to abandon the project 1 year from now if things go south or if the taxes pass. So instead of delaying it, what we're doing is we're just going to go with the project and then we're going to see what happens next year. And if something that happens, we could delay it after year 1. That's that. That'd be we'll do that down there. So we got those positive cash flows. I'm going to go out and go out. And then let me see how I did that. And I just did net present value, 50/50. All right, so we want to do, instead of doing that, the other one I did, remember I did the net present value, then I multiply times the probability. And here we're just going to do the probability right away. So we're going to do the net present value. It's that cash flow. Remember that's times 0. It's out of it, out of the net present value. Oh. And I did not put my interest. Let's see where I put that interest rate at. The WACC above 0. Okay. So this is where the WACC is. And then it is a 11.8%. And now we could type it in. So this is already in the present value. That's going to be the net present value. And we'll do the rate. And then we're going to do the future cash flows. And then what we're going to do is do the same thing here. Oh, yeah. Let's do the trick one or the quick one. Well, we'll just do the function of 4 for the interest rate, so I don't have to have that dragged down, but I want everything else to drag down. If you notice, that's a positive value. So this is going to be an interesting one. Now see the expected net present value. So the expected net present value will be this times 0.5. Remember the other way I did it? I did the step. I'm just skipping that step and doing it right into the expected. And then it's plus this times that, 50%. So the project's going to make money. Now the delay option, if there's a positive on both up and down, there's no reason to do it on the delay option. But let's see if there's a purpose to do it for this one. So we're going to do, we'll do the same thing. We'll kind of follow what it says. No, you know what? Don't ever type too much. Well, I guess it could have been quicker if I just did it that way. But all right, no tax. And then we have that gap when you go one up, probability of it happening. And what is that? A 50/50. Do I have it in the right spot? It didn't light up. I think it is in the right spot, but maybe it just doesn't light up. All right, 50/50 there. And then we'll do our cash flows. Oh. All right. And then our years. Well, that's not going to change at all. So I wonder if I do have in the wrong spot. G24. Let me just check something real quick. I must not had it lit up green. No big deal. Let's go on. Oh, wait. I did put a negative there. Oh, I know what I did. Okay. I did a negative of a negative because I tried to copy that down. So let's just type in negative 4.8. That made it positive, so it does light up green. Okay, so we got these cash flows. So we'll enter it in. Remember, there's not a delay option, so that didn't change. So in the positive, it's going up. All that happens. We could abandon it in the negative, but that's a positive. This might be a bad example to show what happens because we're making money either way. I think what I wanted to show, let's just see if that works. I wanted to show, what if we abandon it after, if it does pass the tax, what if it goes down? What if we abandon it? I think that's what I wanted to show. Let's just double check. So we'll take this and then we'll do what we did before. And just so you know, okay, I'll know here, just so you know, this is not the case. When you do this example, this will be a negative net present value. And I haven't done this in class, this part, in a while. So I'm trying to remember why. If this is positive, if I actually just did it. So what it is, if it goes south, we can end it after year one. I guess what we could do is see if we could abandon it after year one. Let's see what the cash flows are. I guarantee it's going to be negative in that regard. So it'd be this, right? Plus, oh, I'm missing the whole thing here. All right, I forgot. Got to read the problem. If you read the problem on, so you could abandon it. If we abandon it after year one, the positive value kind of threw me off. I kind of forgot about this. We could sell the assets that we have, the property, for $4.85 million if we abandon it. If we abandon it at year one. So that's part of the option. So right here at year one as a $4.85 million. So those are both happening. Now we would say these years, right, if we abandon it, would not have any cash flow. Now I remember why I did that. All right, so we'll go equals, and now let's see what the cash flows are. So we're going to go at times 0, and then we're going to say plus. And look what's going on. This is important here, is that we got 1 year of positive cash flow, or the 1.33 million, and then we abandon it. We sell it off. We get 4.85 million in that year. So we don't want to say 1.3 comma 4.85. Then it would treat the 4.85 in year 2. So what I want to do is put the 1.33 plus the 4.85. Year 1 will have 2 values. I'm just adding those up. 0.73. So the expected value, as you can see, if we abandon the project, it may be worth it. So I'm going to go here and we want to say, okay, no tax, there's a 50% chance. So that's the expected is 50% of that. Plus, if there is a tax, there is a 50%. That's our expected net present value if we abandon the project for the 4.85 million. Now we want to say, what is the value of the option? If this was negative, the value of the option is the option. If this is positive, the value of the option is the difference between the option and the normal cash flows. So that's what the option is worth, $355,000. That makes sense. That's real important, is that the expected, if this was negative, this project's worth 0 to us. So we do that minus 0. If this is positive, again, I'll do this minus that. So that's important to see. There you go. That's all the I have for you today. So you have to follow what I did. You have to do that one. And then you could practice on these. I have the gray cell, so you don't have to worry about typing it up. Just do it pretty quick. Any questions, please let me know, and God bless.